Mr. Speaker, there are encouraging signs of stronger recovery in the global economy as we enter 2011. But it remains essentially what is now called a two-speed recovery. There is moderate growth in the United States and slower growth in parts of Europe again, whereas China and many other emerging economies continue to expand quite rapidly. The roots of this divergent growth path lies in the unbalanced structure of world growth in the years leading up to the financial crisis. World growth came to rely too heavily on countries that exhibited overly high consumption, financed by countries with high savings and large trade surpluses. The financial crisis and subsequent recession brought painful adjustments. However, the shift in world trade, investment, manufacturing, incomes, and consumption is a structural transition that will take many years as a multipolar world evolves. Until the turn of the century, developing countries accounted for about 20% of global output. This will increase to 40% by about 2015. So the world is indeed changing, and the balance, if you like, is moving eastwards and southwards. Developing economies in Africa, Latin America, and South Asia will play an increasingly important role in the global economy in coming years as incomes rise and poverty falls. South Africa's invitation to join BRIC economies reflects this broadening of the sources of economic growth. Over the next 5 years, these economies will account for 36% of world economic growth. We have to construct our own growth and development strategies to propel our economy forward, to create jobs, and above all, to compete on the global stage. The new growth path outlines our approach to accelerate growth and employment, focusing on several key drivers: continuing and broadening public investment in infrastructure, targeting more labor-absorbing activities in agricultural and mining value chains, manufacturing, construction, and services, promoting innovation through the green economy initiatives, and supporting rural development and regional integration. The latest estimate released by the Statistician General yesterday is that the domestic economy, that's the South African economy, grew by 2.8% in 2010. Strong commodity prices, low interest rates, and faster global growth have been the main forces behind our economic recovery. Improving household consumption and accelerating investment will support an increase in economic growth over the medium term. Real GDP growth is projected to reach 3.4% this year, 4.1% next year, and 4.4% in 2013. Steady employment gains, although inadequate, of about 2% a year, will raise disposable incomes, supporting household consumption and investment. Private gross fixed capital formation, this is investment in our economy, increased in the second and third quarters of 2010, a positive sign, a marked turnaround after 5 successive quarters of decline. Total investment is expected to grow by 3.9% this year. The buoyancy of the investment recovery is an important determinant of future economic growth. Real growth in exports is expected to average 6.5% a year over the medium term as commodity exports benefit from strong demand and high prices. Inflation is forecast to remain within the target range of 3 to 6%, edging towards the upper end of the range in 2013 as the economy strengthens. However, increasing food and oil prices represent serious risks to the inflation outlook. The price of Brent crude oil yesterday reached $107. Further increases will put upward pressure on prices more broadly. The improved terms of trade for South Africa contributed to a better current account deficit for 2010 than was expected a year ago. As it widens from the 3.2% of GDP expected this year to 5% in 2013, we would like it to reflect rapidly rising investment rather than higher consumption.